Hi, my name is Josette Leblanc, and I'm co-owner of Nico Renovations and Belle Maison. Today, we're chatting with Matt Mackay, a mortgage broker at Expert Mortgage Group, as well as Julia Menard, who's a mortgage associate. Today, we're talking everything renovation financing, including myth-busting our common misconceptions. What I wanted to ask you is what are the common types of financing that homeowners can use as an option to renovate their homes?
Finance it yourself using your own personal savings. You can use a personal line of credit. And then we can help on the lending side to put it into your mortgage, do a home equity line of credit, and merging everything into one payment to make it more simple. Or if it's an ongoing renovation that you're doing, then the home equity line of credit is the best option for that, is you can use it and pay it off, and then you have the funds when you need them. You don't have to borrow the funds all up front.
Oh, I see.
Yeah.
Okay. So as a homeowner, the various options, are there any pros and cons that as a homeowner I need to take into consideration in terms of the various options?
Not really. I think it's just cost is the biggest thing for a lot of people, is the cost of doing this. And what are they comfortable with payments? And then we negotiate that into and use that information to come up with a good plan for them to set them up for success.
Okay.
Yeah.
And I think one thing that a lot of homeowners miss sometimes is when they're buying a home is that they're not doing the improvements that they should do when they're purchasing it. So for example, if you're buying and you're putting 5% down, then if you come to us afterwards, you're not going to have the sufficient amount of equity to be able to refinance, because we can only go up to 80% of the value. So when you're buying, it's an opportunity to be able to do some of the renovations that need to be done and go and finance 95% of it instead of waiting afterwards, because sometimes we'll see clients fall into that trap essentially of not doing it right the first time.
Okay.
Yep.
Perfect. So that's an interesting question you mentioned about the 5%. So when doing a renovation, are there any pre-qualifications, like a minimum that homeowners need to have up front prior to being approved?
Depending on what we're talking about. So if we're talking about just refinancing, then we just do an income verification on them. We make sure that the income is there, there's no taxes owing for different industries. And if you're self-employed, there are documents, of course, that we need to follow with that. But for the refinance, it's typically a fairly easy process to go through. If you're talking about the Purchase Plus Improvements program, there is a little more to it than that, because most times we need the quotes right up front to provide to the lender to show them what the improvements are going to be, and then there's an appraisal required.
Okay.
To do that. Whereas when we refinance, we may not need an appraisal depending on how much equity is in the home. Currently, we may not need an appraisal to confirm that. They might just have enough equity to do the renovations. They don't need more.
Okay.
Yeah.
Just for clarification basis, when we say refinancing, what does that actually mean?
So refinancing is taking the equity from the house and using it for your renovation needs or paying off debts. Or both.
So as an example, if I own a home and my home is worth $400,000 and I currently have a mortgage of $200,000.
Yes.
So what does that mean?
It means you've got about $120,000 available to you.
Okay.
To use as you need it.
Okay, excellent.
Depending, of course, on approval. But we're able to go up to 80% of the value of the home. So with a $400,000 value, that's $320,000. Then you have an extra $120,000 to use. And you don't have to use the entire thing if you don't want to, is
Okay.
the other thing.
So how do we go about that? If somebody's looking to renovate their home, and let's say they qualify for the $120,000, how would you suggest that a homeowner go about figuring out, okay, how do I know how much it's going to cost?
So I guess on that, if they get a quotation and it's beyond that $120,000 and they don't have enough equity in their home to be able to do it, so one of the other options would be that they fund it personally through a line of credit or personal loan, and then afterwards, once the value of the home has increased, then we can go up to 80% of the value. But one thing that sometimes people forget is that it doesn't always increase dollar for dollar. So if you're putting in a pool, for example, or if you redo all of the electrical or the plumbing into your home, it's not necessarily going to add that same value. So sometimes you have to look at the aftermath of what the home will be worth to do the reverse math, essentially to see how much equity that they have actually available. And when they do a personal loan or a line of credit, this way you increase the value before you go through your refinance. because a lot of lenders won't lend on they won't do a refinance plus improvements, typically a purchase plus improvement. So it just gives you more option, but you want to make sure that you can put all the pieces back together afterwards.
Absolutely. So in that particular case, then, it would be prudent for a homeowner to have all of their quotes, I guess, or prior to going to see you, or should they go see you first and see what they qualify for so that they can kind of set the bar, I guess, in terms of what their budget or their budget range is prior to going to see a contractor or somebody to do a renovation? What comes first in your opinion?
Well, there's always two types of different clients, right? There's the clients that can afford it and they're prudent because they'll want to make sure that everything works, and then there's those that are wanting those renovations in place and may or may not be able to afford it. So it's if the clients know that their ability to repay and their debt ratio and stuff is in line, great. Now, like some clients know essentially because they have room in their budget and so on. Some of the other clients essentially that don't, like it would be prudent to get all of the quotes and estimates and making sure that those things happen throughout that process so they're not stuck at the end. And we see that also on home constructions, like clients that will basically have the funds to finance their home purchase or construction, sorry, and they run out of funds. So if they run out of funds, then it leaves very few options. Like we have to typically go to a private lender to get the house finished and then come back to a traditional lender afterwards to put the pieces back together. So always best to be prudent, but yeah, some clients know. Yeah.
Okay.
Mm-hmm.
Okay.
It is always a good idea to have an idea. You don't necessarily need to have the quotes, but just to have an idea is really helpful for us. So that when I'm sitting with a client and they're asking me for extra money and I say, how much is it going to cost? It's good to know, just even a ballpark.
Okay.
Yeah.
Yeah. No, that makes sense. In terms of the financing that they choose to go with, in terms of the options, is there any type of financing that could affect either the budget that they have, the timeline, or even the project scope?
Yeah, so with renovations, if we're just doing a refinance, a simple refinance, there's no timeline because most of the time we're using the equity that they currently have. There are options. There's a variable mortgage and then there's the fixed rate mortgage. And then we have ratios that we have to follow in order to approve the clients.
Mm-hmm.
And we have to stick within those ratios. And because they are regulated by the government, by the lenders, and by us in order to assure that we're not setting the clients up for failure in the future.
Absolutely.
We want to make sure that they can afford the renovation that they want and dial them back a little bit if they're dreaming a little bit too far. We need to have that conversation with them as well.
Okay.
To say, okay, you can afford this, but you can't afford this.
Right.
And so we do have those tough conversations with them sometimes about affordability
Mm-hmm.
and looking at what they currently have as current debt load and then adding on this new amount. What do we need to do to make it work for them? Sometimes
Right.
we pay off some other debts and give them the money that they're looking for. There's so many different ways for us to look at a
Like
file.
every client is kind of has its own solution. Like
Yes.
it's not one size fits all.
Exactly.
Very
Exactly.
customizable.
Yes. Yeah.
Okay.
And also on that, just when we have clients that have the ability to have a home equity line of credit, that's always a good option for the clients that just want to do some renovation, but what it gives them is the ability to pay as they're going along and basically be able to pick what they're going to do because it's their equity. So a home equity line of credit is you can use it for a trip around the world or you can use it for renovations. It's your capital essentially, so you're able to deploy it as you want. But also what we enjoy about a line of credit is that gives them that freedom long term. So once they have that paid off, whether they're sending their kids to post-secondary or anything, like it's a vehicle that's there for life.
That's available.
Yeah,
For all their family needs.
Absolutely, yeah.
Okay, that's awesome. So question that I guess a topic that we touched on a little bit was affordability. So in terms of clients coming to see you, how is it that we're able to determine what they can afford before starting to do the renovation or starting to get their quotes and stuff like that? What do you recommend in terms of doing the financial planning with the clients up front?
I always look at we always pull credit because that gives us a really good financial picture.
So a credit score
Credit
is important?
score is important, but also what credit they currently carry.
Okay.
What do they have available? What income do they have? And there are some lenders and some credit companies that don't report to both credit bureaus. So with that, we have to make sure that we've got all the information.
Okay.
Because there's nothing worse than getting to the finish end and then find out that there's 3 loans that aren't showing because
Right.
they're on one of the credit reports that we didn't show on the other one. So it's important for us to have a good financial picture of those clients to ensure that we're setting them up in the right path and not taking them all the way down the path and then find out we can't do it at the end.
And so that, like everybody on the team essentially is experienced. So like we always we just bring in people that are experienced, I guess, to be able to get all of these things, I guess, done up front before the finish line. So we might ask for a lot more documentation than just kind of an online pre-approval. But for an example, if somebody just started a position and they're commission based and they were, and we might not be able to use their income up until a certain point, right? So we're asking these questions when it comes to income, bonuses, variable compensation, and so on, to make sure that there's no surprises, to
Yeah.
Julia's point, because we've got a lot of different lending options, but we don't guess anything. Like there's some experience behind all of the madness of it, essentially, because like you have to do all the checks and balances. Yeah.
Perfect.
Yeah.
Yeah.
So as a homeowner, if I wanted to do a renovation, how long in advance would you suggest that they come see you? So let's say they want to do a renovation in 2026, let's say. How many months or weeks or whatever would you recommend that they come see you? So to kind of figure out, what is it that they can afford?
Typical process takes about 4 to 6 weeks
Okay.
from application to funding. So if they can give us about that amount of time, that would be great. Sometimes clients match it so that it goes with the maturity of their mortgage. So also keeping in mind that it's still a 4 to 6 week process to get everything done. Very much depending on what we're doing as well, things could alter that timeline, but that is a typical timeline for getting
A
to
typical
the, yeah.
timeline to get approved, I guess, or
Well-
to find out what you can afford,
No, it's even getting right straight through to funding.
right through to find out.
Yeah, the actual approval point is usually a week or so, depending
Okay.
on how quickly we can get documents from clients.
And depending how organized that the clients
Yes,
are, I guess.
yes.
If they can follow our speed, then we can move stuff fast,
Yes.
through the process. But
Yeah.
if they don't have their notice of assessments, they have to order them. They have to chase their paperwork because they haven't kept them. Then everything delays the process because we have to have the file ready essentially before submitting. So it's very client dependent on how organized they are
Yeah.
too.
Okay, and if you're doing the final approval, in some cases, do you require the quotes from the contractors? Like, so if that's a requirement, yes or no, depends on purchase plus
Well,
improvements or?
Yeah, so purchase plus improvement, we have to submit it with the actual submission to the lender. Because if, for an example, if you're buying a $400,000 home and you're putting $40,000 in renovations, those $40,000 of renovations have to add the value to the home to bring it to 440. Then we can finance 95% of that 440. So but they will oftentimes request for an appraisal to determine, if the value will be there once the improvements have been done. So typically what happens is they hold the funds, and then once the funds the renovations are complete and there's an inspection or invoices depending on the lender, then they'll release those funds afterwards to confirm that the money has actually been used for improvements and not just for something else. So like stuff like we can't include furniture, we can't include some of these things. It has to increase the value of the home, right? So
Right.
so because of that reason, the quote is needed up front. Well, if somebody's doing a renovation, a refinance, then you're using your own equity. So it's your capital.
It doesn't
Yeah,
matter.
Yeah.
Okay, all right. So let me see here. In terms of a pre-approval, would you recommend that clients looking at doing a renovation using financing get a pre-approval before signing any contracts to have a renovation done?
Yep,
Yeah,
absolutely.
okay.
It's also worth it for the client just to know that they can afford this. And sometimes the expectation is not always the outcome. So it's always good to be set up properly and set up right so that you're not surprised.
Right.
Yeah.
And and we've seen all sorts of scenarios. Like, you want to make sure that the two applicants have, good credit scores, and there's nothing that's hiding in behind essentially the finances in like, so it surfaces these conversations and make sure
Yeah.
that everything is in line, because it's you never know. And sometimes like stuff can pop up on a credit bureau too that it's not even the applicant's the
Yes.
applicant's information. So if
Yeah.
there's a correction that needs to happen, those things take time. Like we have contacts that can help fix these things, but it doesn't happen overnight.
Right.
Like you have to go through the credit bureaus and through those third party facilitators to update that information. And on that note, like, I mean, you can order your credit bureau once a year for free, and they'll send you to make sure that it's accurate, right? So always a good thing essentially to be well prepared.
Right.
Yeah.
So would maybe 3 to 6 months be a good window of preparation in terms of getting, figuring out what it is that you want to do in terms of a renovation and establishing a budget, going to make sure that you have your finances in place, like do these two match, and by the time you get all of that in place, it
Yeah.
can take a while, and then you get your final pre-approval that, okay, you can move forward with this prior to signing any
Yeah.
contracts. So maybe 3 to 6 months would be a good, I guess, time frame for people to, maybe embrace in terms of embarking on a renovation project, especially of a larger scale.
Yeah.
Yeah.
Preparation is always the key to everything. Being prepared and knowing what you've got and knowing what you can do and knowing what you're comfortable with is also something. Just because I can tell you can afford $850 a month, some people aren't comfortable with that payment.
Very good point. Yep.
So you have to be comfortable knowing that if you're going to do this renovation, you have to be comfortable knowing that you're going to pay more
Right.
in your mortgage payment. The interest is going to be much less doing it via mortgage versus a personal loan or even a line of credit. But the payment is very important to a lot of clients. And that's something that we have to be acknowledging every time. And I could have a couple sitting in front of me and he's very much okay with it or she's not, or vice versa. And because every couple and every person, you have your own risk level that you're willing to get to. So you have to be comfortable knowing that your payment's going to increase. And especially even with the purchase plus improvements, like Matt said, it's based on 95% of the as complete value, not your purchase price. So sometimes clients don't get that either.
And it's when we're looking at debt ratios, we also don't factor in daycare expenses,
Yep.
for an example, or trips or whatever. Like some folks might have a different lifestyle than
Like a
than somebody else.
discretionary income.
Yeah, and absolutely, and we've seen 15,000-18,000 bucks in daycare costs, right? But those are not included in debt ratio. So if you have young kids, that expense for daycare and your debt ratio is at 42%. Like we're using the total debt servicing ratio based on gross income. So when you're actually looking at the net, if those expenses are all in place, and if the income is less than a certain amount, there's not a lot of funds left over, right? So we don't do budgets with clients, like, but we'll do what we can qualify them for.
Right.
So they want to make sure that they can cover that. And furthermore, like we were doing sub 2% interest rates 5 years ago. Those mortgages are coming up for renewal now. So we'll send our renewal letter 6 months in advance to start looking at those options. But we can lock in rates 60 days to 120 days, depending on the
Yeah.
lenders, if it's a refi or if it's a purchase plus or whichever. So that time frame of 3 to 6 months is good to start the conversation, and then we'll be able to submit it, X amount of time, I guess, before they actually need the funds. And there's nothing to stopping them from doing, and pulling the funds a month in advance if it's a HELOC and it's already set up and ready to go, and then moving forward with renovations a month afterwards, right? So just, I think, being proactive is always key.
So just a question on that. So when you do a refinancing, do you have to wait until your term comes due? Or can you do it midterm?
Well,
go
depends. Yeah, no. Well, depends on the lender if
Yeah.
you're just doing a blended increase, I guess. But yeah,
Yeah, well, there's also, some of our lenders allow second mortgages on their own mortgages.
Okay.
Some lenders, we have other lenders that do second mortgages behind other lenders. So you don't have to wait until your maturity date.
Okay.
It's very client specific
Okay.
as to what you want to do, what your timing looks like, and so on. Sometimes when you are in a mortgage, it may not make sense to pay it out, and other times it does. To break that term, pay out the penalty, and get you into something different. Sometimes it makes sense, and those are calculations that we do. So when I'm looking at a whole file and I look at all the different options, okay, if we pay out the existing mortgage, this is the penalty, and we can find out that usually from the lenders for the clients. And so we look at that and we do a financial picture based on that. And then we do a financial picture based on doing a second mortgage or a home equity line of credit. essentially to accommodate what you're wanting to do,
Mhm.
but not break your current mortgage.
And we had a scenario just recently where the applicant was paying like 1.89 or something for 5 years up until August of next year. So if we break that contract, that lender did not allow the contract to be broken to do a blended increase. So in that case, the cost of interest was about $14,000 extra to break the contract to move it right now to another lender, right? So when you're looking at that, it's like, okay, well, your renovation costs are going to be 14 grand more because of your extra interest plus the prepayment penalty that they'll charge essentially to do so. So in that case, that's when you might want to explore a second mortgage and then roll them all into one essentially, if that lender allows to have a second mortgage in behind, or another lender, I guess, or bumping up that mortgage. So
Okay.
it's and having like how many lenders? Like 28 lenders?
28 to 30 different lenders, depending on what we're doing.
And every avenue is different, right? Like their terms and condition, the way that they lend, their process, and everything that they do. So it's really kind of understanding all of the components of each, and it's and keeping up to date, I guess, on our part, to making sure that we have all that
So
information.
really, it sounds like various circumstances that customers may find themselves in, or homeowners, you probably have a solution for them because you have such a variety of
Yes.
options available. So and every client is unique, so one solution might not fit the other. So it's really important that they meet up with you guys to figure out, okay, what's the best solution for my particular situation.
Exactly.
Okay.
And our lenders are also very accommodating in a lot of ways. They will look at things with us and go, you know what, let's look at it this way. And they'll flip it around a little bit different. Still all within policy and regulations, but they're able to look at something a little bit different, which is great. So that's why using, within the broker channel, having those 28 to 30 different lenders at your fingertips is wonderful. In the fact that not every lender is exactly the same way as the next one. They're all very competitive with each other, but they all have their own little niche that
Exactly.
And it's very interesting. Like sometimes when folks transition to the broker world, is they were used to having one product and one set of policies and so on. While in the broker world, like there's such a vast variety of options. So that's where we'll come in and say, okay, Julia, like where does this fit? Like, and it, it just it's you have to be able to navigate all of those essentially to make sure that, because the bank is never going to send you to the bank across the street, right?
Right.
But for us, like we're having all of those options. Typically, if we can't get it done, that means that it shouldn't get done essentially, because we get such a vast number of options.
There are issues greater than.
Yeah, exactly.
Yes.
Yeah.
Yes, because we have anywhere from the traditional lender, the big banks and the monoline lenders, to alternative lenders, to private lenders. So like Matt said, if it doesn't work within any of those, then you
Probably shouldn't do it.
Probably shouldn't be doing it.
Exactly.
Right.
Yeah.
Okay. Very interesting.
And let me just throw in a little thought that I just had there with that one. Before you do anything, get yourself into CS. Before you start your renovations, because as soon as you start your renovations, then that can affect the value of the house depending on what you're doing. So before you start tearing down walls and punching holes in ceilings, come see us, get the money, and then you can start tearing down walls.
Because you might be devaluing your
Yes.
home before you can actually qualify for the
Exactly.
mortgage.
Yeah.
And then your house is worth more.
Because I
less.
have done appraisals where the clients started the renovations before and took out all their kitchen cupboards and took out a wall in between rooms, and all of a sudden now I can't do it because they're mid-renovation.
And lenders look at an appraisal based on lending purposes. So there's different types of appraisals. If you have an appraisal based on resale and you have a 6-month exposure time, it's going to be a different valuation than if you're looking at a forced value. For example, if the private lender would be a lender, or lender wants a 3 months exposure time, and you've ripped out the kitchen because it's not going to be as appealing or marketable as a property, right? So that's a great point, because we've seen clients just and you know what, they don't know. They
And
just
that's
don't
it.
know, and they've done it, and they fall into that position, but.
Yep.
After it's done,
Not
there's
much can be done.
no, and your house is going to be worth a lot more with cabinets from the 90s than it will be with no cabinets. So
That's right.
Yeah.
Yep.
Interesting.
Yep.
All right. Well, I have a different question for you. Like, in terms of the borrowing world and homeowners, what are some misconceptions like that are kind of revolving around in homeowners' heads these days?
Variable rates.
Variable rates are one thing. So
Better.
variable rates in the last few years have not been as attractive as the fixed rates. Because Bank of Canada, because of things that have gone on in Canada, they've had to make some changes, and the bank rate went up and up and up. So variable rates are not as attractive as they used to be. They're becoming a little more attractive now because of yesterday's Bank of Canada announcement. So variable rates are one thing that lenders don't understand. They also, some lenders who are self-employed don't think, oh, I can't get anything because I'm self-employed. Nobody wants to talk to people who are self-employed. Bring it on. I love it. It's a world of so many options and so many different ways of looking at things and looking at, looking at their income. There's different ways I can use your income.
Okay.
So it's not just a cookie cutter.
So if I'm an entrepreneur,
Yeah.
then I definitely need to, I do qualify, or I may qualify, so
you
I should.
can. Yeah.
I need to find
Yeah.
out.
Yeah.
And some lenders will use what we call a stated income. So they'll look at your business financials. They'll look at what would be a normalized income if you were to be working for someone else. And some of them will use 12 months of bank statements to look at the actual numbers, right? So
Yeah.
there's different expenses that you can write off on your financials, like your amortization, depreciation. Those are accounting, they're accounting expenses, but they're not an actual expense to you, like that affects
Right.
your money in, money out type of deal, right? So it's but that's a great point, and we get that question a lot on the variable. It's just like variable rate. The Bank of Canada drops their overnight rate, and then we get calls of, well, I'm going to wait just until the fixed rates go down. Well, there's not a direct relation to fixed rates and variable rates, but on that note, we have to qualify clients on a higher interest rate than what they're actually getting. So when we're looking at the contract, we'll have to add, for an example, a fixed rate at 2% to the 5-year fixed rate as a qualifying rate. So the reason that happens is when there's changes to the rates, like we've seen from sub 2% to now in the 4s, is the clients can still actually afford their home in lieu of when the rate goes up, like we've seen in the 2008 housing bubble in the U.S. is the mortgages were coming up to maturity or whichever, and then they can't afford it anymore because there was no stress test on
Right.
the actual qualification. So contrary to a lot of beliefs that some clients are going to lose their home because the rates have gone up, maybe they've mismanaged their funds, but typically we're adding a buffer on
Right.
that approval. So they shouldn't if
Yeah.
they were properly managing
Yeah.
anything else outside of, like everything else, like outside of their mortgage.
Yeah.
Yeah.
And I think a lot of clients will be surprised when they do get, if they're in 1.89% now and it goes up to 4.24%, for example, their payment doesn't increase. It doesn't double. Just because your interest rate doubled doesn't mean your payments are going to double.
Mm-hmm.
So there's that misconception out there as well as yes, the interest rate's going to increase, but your payment doesn't increase as much as you're expecting it to.
I would say that that's definitely a big misconception. Yeah.
Yeah.
For sure.
And we've seen like comments, rates, or people think that 4s or 5s are extremely high interest rates, but like they haven't lived in the 80s when it was 22.75 or 12 to 14 in the 90s, right? So we're still into very cheap, affordable interest rate levels right now. So it's
Absolutely.
folks that are waiting or that have been waiting for the rates to go back down are going to pay a lot more for your home because the house values are always increasing, especially in Atlantic Canada, where we don't see as much fluctuation like you would see in different metropolitan areas.
Absolutely.
Order flood by supply.
One question I have, just based on eligibility, we talked about people working, people that are self-employed. What about people that are retired or on a fixed income, and maybe they're aging and they need to make some modifications to their homes, but they're no longer working, they're retired. What options do they qualify, first of all, and how would something like that work?
So we do have a really terrific reverse mortgage. I think it's commonly known as the chip mortgage. And you see the skater, Scott, I can't think of his last name, but Scott on TV, skating around talking about chip mortgages. They're really terrific options for the seniors who are living on a fixed budget, and they own their home free and clear. They can get non-taxable income or non-taxable money from their house to use for renovations that they might need to do. If they need to bring in-home care because they're in a situation where they need that for one or both of them. And it's really great because then they also don't have to make any payments on that mortgage. So even
Really?
though they're on a fixed income, they can get money, and that money, that the amount of money that they're able to get is based on their age, the location, the value of the house, and so on. So it's very much, there's very specific things that we have to follow, but it's absolutely terrific setup for people that are on that fixed income. It's anywhere from 55 years and up, but the older you are, the more you'll actually gain access to of the equity of your home. And then when you're ready to either sell your home, you have to move into a senior's residence, or you have unfortunately passed, then that's when the mortgage gets paid back with the interest that's owing at that point. And it's still, your family and your estate and or yourselves are still able to walk away with an incredible amount of equity from your home. They don't take 80% or 90% of your home. It's based on calculations that are set up so that you're just getting some of the equity. You're not getting all of it at the right time.
Plus, if you're doing renovations, you might actually be increasing the value
Yes.
of your home
Yeah.
in addition to getting
Yep.
the loan. Okay.
And we've seen rents, go up significantly. So for somebody that's on a fixed income or retirement income, might not be able to afford for a very long time the rents that are being charged today, right? So if they can prolong the how long that they'll live in their home, great. It gives them another option. People are living longer and being more active for longer, right? So they want to stay in their home. So it might give them the ability to do a reduced mobility access ramp or whichever. But one thing that the way that it's set up to on the reverse mortgage is that the loan to value, and when I say loan to value, it's the amount of mortgage that you have based on the value of your home. The way that it's done is that it's not going to put you in a position where you're going to owe more than the value of the home. So that's why it's based on age. So if you're 75 or 80 and they look at the life expectancy, they'll say, okay, this is the amount of money that we can lend you. And if you're not making any payments on it, this is the gradual increase of the value of the mortgage owing, because your interest is going to accumulate to it.
Yeah.
If we're seeing an increase in the house values, you're also increasing the value of the home. So you should be going up to a certain parallel increase, right? But we've seen different usage for a reverse mortgage too, where it might be folks that want to give a part of their estate now to their kids that are looking to buy a home. So the home might be worth more now to their kids than in 20 years from now, right?
Yeah,
So if they can see their kids and their kids and their grandkids enjoy a home today because they gave them part of an equity to do a down payment versus waiting 20 years when they might not need it, like it might be a better value where they can actually see them enjoy it, right?
Exactly.
So it's being used as a tool, but and also you have the ability to make those interest payments. If you don't want to leave a bigger balance than what you've borrowed, you can make the interest payments. There's so many ways that you can set up. You can set it up that you have monthly income coming from the equity of your home that's tax free. So great
tool.
Great tool. Yeah, absolutely.
Yeah.
And it's not a fit for everybody, but those that it is a fit, then great. Like it has to have a value of at least 250,000.
Yes.
It's based on age and so on. But
Yeah.
and even if there's credit challenges, we can still do them because it's based on the equity. It's not on a
Yeah, it's
prepayment.
not based on your income.
Yep.
Interesting.
I did one a few years ago for a gentleman who wanted to renovate his basement to put in a suite that he could rent out. He still shared the kitchen, but this suite that he put in a bathroom and a bedroom and a little living room in his basement. So he used that money, and now he's got a renter in his house, somebody that just lives in the basement, shares his kitchen on the main floor, but now he's got some extra income coming from that as well. And he's making the interest-only payments so that when it's time and he needs to sell the house, then he's set up for success for the future. So he doesn't have to worry about where is he going to get his extra income.
Right.
Where is he going to get the money to pay for his next step in life? So
Exactly.
yeah, it's a really
Wow.
terrific program.
Yeah.
Yeah.
And I assume not everybody offers that either.
Yeah.
No. Okay.
No.
Oh, interesting.
Yeah.
So one of the things you mentioned about like an income suite, is that something that's easy to finance? Like we're getting a lot of clients because of the housing shortage and the rents that are, lack of living spaces, I guess, in short. A lot of people are calling us to see if they can do an income suite in their basement or an addition and all that kind of stuff. How does that work? Is that, I assume that might be a little bit different in terms of qualification, or, how do you
It
assume
is. So there is a new program that's out. It's very new, so there's not a lot of information on it yet. And in renovating your house to do an income suite. again, you can use the equity that you already have, and that's sometimes sufficient enough to do this equity, the income suite that you're looking at, just the equity you currently have. So it's again still the whole process of approval,
Okay.
of looking at all the costs, looking at what you're doing, looking at what that rental income could look like, because it would have to be a legal rental suite. And then
In order to qualify.
in order to qualify, but also in order to include it with your cost to ensure that your ratios are going to be met
Right.
in order to be able to afford this next step that you want to take.
Mm-hmm.
So it's definitely a possibility. And again, like I said, most clients, if they want to do this, they have the equity already in their home.
Right.
Yeah.
And it's so funny, like how people think that it's so easy, right? You just put in the door and you're good to go.
Yeah.
But it's not. I mean, there's codes that have to be followed and so on.
And
Yeah.
permits and
Yeah, absolutely.
So you
Yeah.
need to, so in order to get the financing, in order to put an income suite, you would require the building code, the building permits and all that kind of stuff in order to get the funds.
The lenders are going to want to see something because it's a structural change.
Right.
So they're going to want to see something. They want to know that it's doing it properly.
Right.
Unless they're pulling the equity themselves and then they're
And then
doing
just
whatever
doing
they
it,
want
yeah.
with the funds because
Yeah.
then it's their money, right? So
Right.
if they do something, then it's
Yeah.
up to them to the lender's not going to verify afterwards because they've just given them the equity that's
Yeah.
in the house.
Right.
So
But there are some programs, I believe, that provide some grants in order to provide more housing availability. So I think you need to qualify for that, and there's some strict guidelines
Yes.
in order
Yeah.
to do that. So
Yeah.
yeah, that might be one to need to look into. So last question for you. If somebody is looking at doing a renovation, what are the common red flags or common pitfalls that people find themselves into or forget? I'm just thinking like, if I have a budget and I'm doing a renovation, how much should I put aside for contingency? Because really, how often something comes up when a renovation, because it's not a new build, right? It's you're modifying an existing structure, so you don't know necessarily what's behind the walls. So they might find something that needs to be repaired, or you're in the middle of the renovation and you just thought that, oh, you know what? If we added some electrical here, that would be much more convenient. You know, what would you, I guess, advise clients to use as a good contingency to make sure that they're doing it right?
I'm going to say 10%. I'm going to use the construction world. In construction, lenders like to see that the clients have 10% of the build cost set aside for extras, for the just in case, for the, oh, we didn't think about that, or we've changed our minds from the regular drawer pulls on your kitchen cabinets to the high-end elite,
Yeah.
made of marble from Italy drawer pulls. Not that there's anything wrong with that, but it will cost you more.
Right.
So those are things that you have to keep in mind. So with renovations, I usually tell clients, just keep aside 10% of it. Make sure you have access to extra just in case you change your mind. Because, and also costs can go up. You've got a quote in front of you, but that doesn't mean that it's 100% always set in stone.
Yeah.
Because the cost for that contractor can go up. The cost of the lumber can go up. The cost of whatever can change.
Tariffs.
So, yes.
and I think one thing that is has to be mentioned too is just not using the cheapest quote that you're getting, right? Really having a contractor that you can trust and really having those conversations, because like a small job might be fine to have a 10%, but if you're going to be putting, wider baseboards and then you have, walls that you're changing in whichever is I think your contractor and renovation companies, the ones that will know best to say, okay, well, this is the amount that should be prudent on it. This is what it should cost you, but this is what it could cost you if something like that happens. Instead of, sometimes we'll see cheapest quote coming in and then it's way beyond. And once the walls have been opened and everything's in place, what do you do? Right? If you don't have the funds, like you're stuck. Like it's unfortunate. People just sometimes shop out for the cheapest one and not looking at the reputation and really the capacity of the contractor, right? So it's, I think that's the...
So what would you recommend in that case? Because there's obviously the cheapest, there's also resale value, quality, warranty. Like what you as a lender, how you're working with lenders, what advice would you give to clients in that particular case?
Well, there's the basic, cheapest renovations that you're going to be able to do, or the ones that you want, or there's the middle ground. the lenders are going to look at the appraisal value and the lending value. So it's, if you're putting in a pool, and I use a pool for an example because it doesn't add dollar for dollar what you're going to put in, right? So if you're going to stay in that home and it's what you want and it fits your lifestyle and you have the ability to pay for it, great. But just understand that you might not get the financing, all the financing for it, right? But if it's something that is, so I guess it depends if it's a need or if it's a want. So that's kind of determining, I guess, the type of money that you'll spend for it. But it's your home. If you want to make it your own and you can afford it, great. That's where you live, and you want to have something that you're proud of, right? So then you can have the ability to have those and do it right. And if you can't afford it right now, maybe you wait 2 or 3 years to get exactly what you want, instead of doing it not the way that you want, being unhappy with it, having to rip it out in 5 years and redo it.
Yeah.
Exactly.
Yeah. Yeah.
Okay.
It's another thing that clients need to look at too is like you said, with the appraised value, the final value of it is going to be the outcome. So windows and roof, we all need windows and roof on a house. It's kind of one of those things.
Mm-hmm.
So whether you put in mid-grade windows or top of the line windows, it's still windows. They're not going to increase the value of the house if you put in the top of the line everything. It's going to help with resale value maybe. But because that's going to be something that the buyers are going to be looking for. New windows, new roof, great. This house is terrific.
Yeah.
But doing this today in your own house, it's not necessarily going to, like Matt was saying earlier, the dollar for dollar is not always going to match. So, because we have to have roof and windows,
Right.
we have to have a furnace.
It's maintenance.
We have to have
Not an upgrade.
So yes.
And also depending on the asset too, right? Like if you're looking at an entry level home and you're putting, marble high end floors in it, like you might not get the next homeowner to pay exactly what you've put into the investment of it. So it's and also just we're talking renovations, but sometimes it's cheaper to renovate your home than to sell your home and buy another one. Like the market value has increased significantly.
Yeah.
So when you're looking at that, it's like, okay, well maybe I can just make it my own with X amount of dollars in the home, and I can and I can choose to live here instead of moving.
Especially during, since COVID, if you've lived in your home prior to COVID, your home value has increased dramatically since then.
Yes.
So you might have quite a bit of equity actually to make it your own.
Yeah.
So,
And sometimes we have the ability to extend the mortgage back to 25 years or 30 years, right? So even if you have, and sometimes I've seen clients, they have 5 years left on their mortgage, but they'll have 50 grand on their line of credit because they can't afford to pay it off in 5 years. Well, you know what? At the end of the day, if you put it all together essentially and you reduce the total cost of interest that you're paying, it might be more prudent and a better option to amortize it on 10 or on 15 years and have a manageable payments that you don't have to go dipping in your line of credit. And your mortgage is typically your cheapest vehicle to have your interest rate.
Yeah.
So wise to look at the total dollar amount that you're spending on interest per year versus trying to pay it off in 5 years.
good advice.
Yeah.
Good advice. Well, thank you both for sharing your wisdom with us today. I do have one last question for you both. If you could leave one thing with homeowners, like some wise words of advice, what would be your parting words today for homeowners that want to do a renovation?
Know what you want. Don't just watch the TikTok videos of the perfect little house out there and everything. Know what's going to work for you. Because just because it looks nice doesn't mean it's actually usable. If you want the high-end marble floors, but that's what you want, go for it. If you can afford it, great. But know what you want is a big thing. Yeah.
How about you, Matt?
I'd say run a budget, run a household budget. Look exactly at what you're spending, what you can afford before going out and spending. So when you're going to see us or your contractor, is to say, okay, I've got I can afford $40,000, and so this way your plan is going to be made on $40,000 instead of looking at all the avenues, because that's exactly when you go in and you see option A, B, C, D, the highest value option is going to be the most appealing one, right? When you're looking at this is the Pinterest home, but it might not be the right time. So it's we've seen clients sometimes get in trouble. They have a good situation, and then the kids pop up and they still want to continue their trips, and they have 2 new cars, and then they're adding up these renovations, and then boom, they can't afford it anymore, right? Mm-hmm. So and if you've tapped out everything and you've tapped out your equity, there's nothing left. like you have to either sell your home or, you know, just look at alternate options when it comes to debt management. But I think
Budgeting.
budget before going, you know, just yeah,
Yep.
before going out to
Go
dream.
talk to you guys so that you know what you can afford
Absolutely.
before you
Yeah.
embark on the
Yeah.
renovation
Yeah.
Yep.
Yeah.
bandwagon.
Yeah.
All right.
Absolutely.
Well, thank you very much.
Thank you.
Really appreciate
you.
it. Were we rolling?
Yeah.
Oh, great. Oh my God. If you can maybe share your information, if people are thinking about a renovation and they need some financial advice or want to look at what lending options are available through your brokerage, how can they get in touch with you?
Yeah, absolutely. So the easiest way is give us a call, 506-866-4654, or we've got a toll free of 1-866-585-2022. So that's two ways to get in touch with our office, and also on our website, Expert GRP, which is short for group.ca. So that'll connect you to us, I guess, and then we can make the right matches depending on the type of project that you're looking to do.
Wonderful. All right. Again, thank you.
Thank you.
Thank you.
If you can maybe share your information, if people are thinking about a renovation and they need some financial advice or want to look at what lending options are available through your brokerage, how can they get in touch with you?
Yeah, absolutely. So the easiest way is give us a call, 506-866-4654, or we've got a toll free of 1-866-585-2022. So that's two ways to get in touch with our office, and also on our website, Expert GRP, which is short for group.ca. So that'll connect you to us, I guess, and then we can make the right matches depending on the type of project that you're looking to do.
Wonderful. All right. Again, thank you.
Thank you.
Thank you.